Hey folks, Dan Ferrer here with your economic news for the week if you're in the housing market. So what we watch on a daily basis, or what I try to do on a daily basis, is inform and educate you guys everything real estate, but we concentrate on the financing piece of the puzzle. I've thought every day giving you guys mortgage rates, what's going on, is a little overdone. So what I decided to do is on Friday, I'll give you a recap for the week. But what I'm going to add to this is over the weekend, I'm going to give you the economic calendar for the following week. I'll give you my expectations, and then on Friday, we'll actually grade how I did. How do you feel about that? So without further ado, let's get to the headline news that we're seeing today. But before we do that, I want to recap something. What is the Federal Reserve doing to the markets right now? Well, we know, especially if you're in the housing industry, they've played havoc on real estate, especially when it comes to mortgage rates. Last year, it was probably about mid-year, we had rates kind of stagnate a little bit, but at the beginning of 2022, did you realize mortgage rates were like 3%? By the end of the year, they came down a little bit, but in November, we hit 7.37%, and then by December, we were back down to maybe 6.5%, and I say back down, but if you look back in time, it's about 150% more than where we were. So why is all this going on? Well, the Federal Reserve says, you know what, inflation is running out of control. We saw inflation basically go from its historic numbers of 2%. It's usually always at 2%. It spiked all the way up and it scared everybody. It was 7, 8, 9%, whatever numbers you want to figure out, because I don't agree with a lot of the economists and a lot of what mainstream media has. So let's just say it went to 9. We're at 7% right now. So let's put this into context. Why is the Federal Reserve so important? Well, they were created for two reasons. One was full employment. Okay, so let's think of that. They want the economy at full employment, so the economy is clicking along and everything's doing well. But they also were created to have price stability or price control, what we call to keep inflation in check. Okay, so they're doing a pretty good job with that if they would give it some time, to work. And I'm going to show you some details on that, how basically all the inflation numbers are starting to roll over. But I want to give you the headlines for today. So remember, the Federal Reserve came out and said, we want to play havoc, or we're going to put hurt on those out there in the housing business and employment. Okay, so now we see today's numbers, and it's like, we got problems, because non-farm payrolls rose. That means more people got jobs than expected. It rose by 223,000 in December as strong job market tops expectations. And then you're like, oh boy, now what's the Federal Reserve going to do? Well, you might be surprised on how the bond market's reacting. Okay, but let's get over the rest economic news that took place this week. So we go through the week, and here's what we see. We see on Monday, really nothing happened. Tuesday, nothing happened. And then on Wednesday, we saw the JOLT index. What the JOLT index is basically how many job openings there are, okay? Did you realize there's 10.5 million job openings? Okay, that's almost 2 job openings for every 1 person looking. So it should be kind of easy to find a job. So I don't know how the Fed is expecting the unemployment number to go up, okay? Because there's so many jobs out there, right? So that's one conundrum. The next thing is we will look at the ADP payroll numbers. So I don't trust ADP. I never have. Great company, but their analysis on the employment numbers are really bad. So they changed their model because it was so bad. The last reading that we had, I think, was the first number based on the new model. So we're going to watch it over time. But I want to show you how their number is not in line with the rest of the numbers that we monitor. You're going to see on Thursday, ADP numbers came out, and let me put my glasses on. The last reading they had was for 182,000 new jobs to be created, okay? Their expectations were for 150,000 jobs to be created. Well, they said 235 jobs actually were created. Okay, so they missed it huge on their expectations. And then but this gives us a starting point of where we're going to start analyzing their data. But hold thoughts there for a second. You go down through here, and today we see the non-farm payroll numbers. Well, the previous reading was 256. Okay, their expectations were for 200. It actually came in at 223. It came in less than they predicted, okay, and a little bit more, or less than it was previously, and a little bit more than expected. So let's go over to here. They had 185. They came in way over. This one was 256 and it came in down. So the non-farm payroll numbers by the government is actually going down. ADP numbers are going up. I don't know what's going on. So then let's go over to the initial jobless claims. Well, let's pass that right now, because what the Federal Reserve is watching is the unemployment numbers. Here's the scary part. The unemployment rate was 3.6. It was expected to go up to 3.7. The Federal Reserve was sitting there saying, yeah. Oh boy, it dropped. So now the Federal Reserve is saying, well, okay, what we're doing isn't working because more and more people are getting jobs. We got to do something. Well, I hope they don't do that, because what they're trying to do is cure inflation. Let's get over to the biggest components of inflation to see where that is. So what we want to do is we want to go over to the first thing is we're going to look at crude oil. Okay, so let's see where crude oil is. Let's go back and look at a 1-year chart of crude oil, where it was. So we go back in June and crude oil was about $122 a barrel. Where is it today? 74. Okay, so that is completely plummeting. Look at that line. Look at that chart. It's down, down, down. Let's go to the other component. This is the biggest component in the inflation numbers is rents or housing costs. Look at the chart down here. This is the last 4 months. The last 4 months, we've had negative numbers when it comes to rentals. And you can validate that right up through here. Our national index fell by 0.8% over the course of December, marking the 4th straight month of declines. So we're starting to see the housing market, and especially rents, starting to turn over. Next piece of the puzzle is lumber. Look where lumber was. Lumber was not too long ago, back in March of last year. $1,400. I say it's a bundle, but it's not a bundle. But just take my concept with this. It was $1,400. I'll say a bundle at that point. You can see it right on your screen. What is it today? $354. So it's dramatically down. So inflation is making a turn down, but the employment numbers are starting to tick up. So now the Federal Reserve is in a conundrum. So based on all that, what would you expect from the bond market? I would expect the bond market to basically just plummet. Let me refresh this because it was up 23. It's still up 19 points. I actually thought this would actually turn on us. Okay, so let me explain what you have on your screen right now. What you're seeing on your screen right now is what's happening to the price of a mortgage-backed security bond. It trades on Wall Street. This bond is the biggest component or the biggest piece of your mortgage rate, okay? So when the price of the bond goes up, all you need to know is rates come down. Okay, so the employment numbers came in really good today. I expected mortgage rates to spike up, but they're actually coming down. So here's where rates are right now. And these are the top 6 products that people choose when they're buying or refinancing a house. You can get this report from Mortgage News Daily. Actually, I have a link of it down below, and I have a whole bunch of other links down below. You can subscribe to my newsletter, which you'll get this and a whole bunch of other information and more. So you're like, Dan, I love your content. What do you guys do? Well, I'm actually a bank. We're a federally chartered bank, and we're probably one of the country's largest mortgage brokerages because we're established with over 85 of the country's largest banks and mortgage companies to be able to use their products and their interest rates help you guys as well. Not only with our bank's products and rates, we can help you with over 85 of the country's largest banks and finance companies. So if you'd like to find out more about me, maybe you listen to podcasts. Check me out on podcasts, whatever one you listen to. I'm on Audacity, Audio Boom, Apple, everything else. But if you really want to find out more about me and my team, just go to therateupdate.com, and here it is. You can give us a call right up here, 844-775-5626. What most people are doing is right over my head, they're booking a meeting. You know, I have about 13 meetings a day. Every half hour on the half hour, I've had meetings this week with people looking to educate themselves on buying a house in 2023. So I hope that's one of you guys that you can set up a consultation with me or one of my salespeople so we can take care of you and answer all your questions. So that's it for today, guys. God bless. Thank you so much for watching. Please don't forget to give us a thumbs up, subscribe down below, hit the bell every time I post a video. You'll get alerted. Take care, guys. Have a fantastic weekend. Bye-bye.